You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. 13 programs, a baker's dozen on the old network. And where can you find all of that volatility and related goodness? Well, of course, on the mothership, the flagship, theoptionsinsider.com. Surf on over there, click on the Insider Radio Network tab, and your adventure has begun. Just click on the show you want, download, stream, and you're good to go. Of course, you can also find it iTunes, TuneIn, Stitcher, pretty much wherever you find your favorite podcast programs, including via your own podcatcher. Just grab the RSS feed. It's easy to do. Or, of course, just grab our mobile app. Doesn't get much easier for that. The Options Insider Radio Network mobile app available in iOS, Android, and the Fire OS. All right, and we'll be joined momentarily by some great potential guests here for our volatility review, as well as, of course, the greasy meatball himself, Mr. Mark Sebastian. So without further ado, let's get right to it. It's time for the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is, of course, a portion of the program where we break down the week that was from a volatility perspective. And what a week it was. We're going to get to it in all sorts of detail. But first, let me welcome on my cohort, my volatility nemesis, my partner in crime, the yin to my yang, the greasy meatball himself, Mr. Mark Sebastian from the Option Pit, as well as his myriad appearances on the Options Insider Radio Network. Mark, welcome back to the Volatility Views program, sir.
It's interesting that the opposite of you is always right, makes money, smart, good-looking, interesting.
None of which I associate with you, but if you feel that way, I allow it, sir. All right, and also joining us on the program today, we have two guests. One is returning, one's a newcomer to the program. They are Matt and Mike Thompson, the trading principals of the Volatility Group over there at Typhon Capital. Matt and Mike, well, Matt, welcome back to the program, and Mike, welcome to the program.
Thanks, glad to be here.
Yeah, thanks, Mark.
This is actually great timing to have you guys on because there's a lot rocking and rolling in your neck of the woods. We'll set this up for you listeners. We are, of course, recording this on Friday, July 17th for all of you playing the home game, and it has been just a quite the week, to say the least, from the volatility perspective. If you guys remember, on our last episode, we had some great guests, and we were also pontificating about what the future lay in store from a volatility perspective. But the Greek thing was how it was going to play out and where the vol would come after that. You remember last week we were flirting, actually briefly, in the VIX Cash, broke the 20 handle to the north, hit 20.05, I believe, on the upside before beginning its remarkable, nearly unprecedented retreat this week. As we are recording this today, VIX Cash hovering almost exactly 8 handles lower, 12.08. That is, if you're playing the home game, listeners, that is the largest 5-day percentage drop in VIX product history. Notably as well, half of those 10 biggest 5-day declines we've seen in VIX history have all occurred since the beginning of 2013, so in the past 2.5 years. So been a volatile period, to say the least. There's a lot to get to, but before I keep going, let me give you guys a chance to weigh in. We'll start with you two guys, our guests, of course. A lot to talk about. I know you guys mostly focus on the VIX Futures side of the curve, so you can start there, or perhaps whatever really caught your eye in this very, very active and interesting volatility week.
Yeah, I think what caught our eye was, more kick the can wins the day, basically. It looked like it was pretty close to actually turning into a meaningful vol event, and then again, the last minute kick the can, kind of turns out in the same vol smash we've seen since the kind of 2011 time frame. So the rationality put wins again.
Yeah, you remember the VIX index only looks out 30 days, so all you got to do is kick the can about 31 days, and VIX will come in quite a bit, and the Europeans are good at figuring out ways to do that.
I like that. The kick the can trade. That's a good one. We may have a good title for the episode. But you're totally right. That is both a strength and a fundamental weakness of the product, the way it's designed. And so, yeah, if you can afford to punt beyond 30 days, you may be able to weather the storm. That's an interesting point. Mr. Sebastian, same question for you. Obviously, it's been a very active week across the board. What really caught your eye in this past week from a vol perspective?
Yeah, I was shocked at the way risk came off. Risk came back on. Obviously, we're always a little precarious about talking about percentage moves at VIX, especially when it's below 20. But the way that we went from a 20 VIX to a VIX with an 11 handle in about a week is just shocking. We saw, we caught a whiff that something was up right around the time Volatility Views was recording last week. Monday pretty much confirmed that, and we went from legitimately worried about the market to all is well, nothing, no fears here, in a just amazingly quick period of time. I have to admit, I was shocked. Sometimes you expect some sort of residual volatility, especially on something that lasted 2 weeks, which is long for these events.
And especially that it's not over.
Yeah, one that's not specifically over. But I was a little surprised they took the VIX down to 13 prior to the big vote. I was surprised that they've taken it down in the 11s prior to the whole deal coming together, because it could fall apart still. So that it just goes to show you that there are still some premium sellers out there, Mark.
Yes, so it's just, there's so many areas to dive into. We'll start with just the VIX Cash, and we'll get into some of your neck of the woods, guys, which is, of course, the futures. I do like that, though, the kick the can trade, because it certainly is apropos for what we saw in the marketplace this week. Again, historic movements out in VIX Cash land. It seems like the market just saying, hey, you know what, the tasty euro situation is behind us. Earnings, there was a little bit of earnings action. We'll talk about that in a little bit, but earnings are clearly not putting any big storms on the horizon from a volatility perspective. And people are saying, yeah, we're heading into the summer doldrums. Greek thing may be done. The Fed thing kind of seems like a bit of a done deal at this point, at least not for till the distant future. They're going to be doing anything towards the end of the year. So near-term sources of vol are few and far between. Speaking of how much the VIX has been moving, at least, of course, we like to look at the VVIX, one of our favorite indicators of the volatility of volatility, and it is back down now after an impressive impressive spike back to the upside. Again, we had it hitting up into the 114 or so in that range. 115 actually hit briefly there. Back down on the lower end of that range again, hovering around 85, 86 right now as we are recording this. So all of you guys out there who are big proponents of watching VVIX and the range of it, perhaps you think it's poised for a bounce again. I know some people like to look at it from that perspective. Looking at just pulling up the numbers out there in VIX land, what we're seeing from an actual realized volatility perspective. 30-day realized on the VIX is whopping 162. And 60-day, a little bit farther out, a little bit more saner minds prevailing. Still a whopping 136. Comparing that to what we're seeing out in the S, about a 30-day realized of about a 12, and a 60-day realized of about an 11. So still a little bit of a premium from a VIX Cash perspective. Speaking of the S&P as well, we're also seeing still not a lot of faith, love, whatever you want to call it, in this rally ho mode. The hedge index rallying up a bit, around 125, bouncing off those lows. Kind of what to be expected given the fact that we have rallied a bit again in the market. Whenever you see that, people perhaps want to put on some hedges, but we're still hovering lower than a lot of people I think expected. We've talked about the vagaries of that index before, so hard to read too much into that. But also is interesting too is just the raw data. Getting back to the futures neck of the woods, for example, the bearish positions in S&P futures, outnumbering bullish by the most in 3 years as data coming out of the CFTC. So the bearish futures specs are still out in force out there in S&P land. And since we're talking futures, guys, I know that's kind of your bailiwick over there at Typhon. You kind of joked about the kick the can trade, but walk us through the past week or two actually from a VIX futures term structure perspective. We see that near end, just vacillating all over the place whenever these kinds of events unfold. You see anything out there that really surprised you? Anything interesting out there that you want to relay to our listeners from a VIX futures, VIX term structure perspective?
Well, we basically saw it's a pretty typical pattern. In the teeth of the volatility, if you can call a 19 volatility, but in the teeth of that, we saw the VIX curve flatten up quite a bit, and right after that when it hit 20 that day, and then they got the vote done, the term structure really steepened out, which is very typical too. So that's the visual representation of kicking the can. It's the July-August vol came way in the fall and beyond kind of stayed bid relative to the near months. So you've basically put out the fire in the next month or two, and there's still the worry farther out.
And what was your approach over there at Typhon? You said you like to kick the can, so do you just avoid the mad end of the term structure, for lack of a better term, or do you try to spread it and take advantage of what are reasonably perceived to be some pretty hefty premiums there in the near term?
Yeah, we came into this week with no positions on just because we're term structure traders, and there wasn't enough edge in the term structure. It was flattish to mildly backward in the front. So after the European and Greek stuff seemed to really cool off, we did take advantage of a spread trade and a few outright trades in the near months, essentially betting on a steepening of the curve, which we saw. So the August-September spread was a nice trade for us. I think that went from 50 cents to the other day to 92 today or so, and that was a reasonably conservative way to play a cooling off of vol and a steepening in the curve.
Yeah, most importantly, it's our favorite code name for a trade. That's the mullet, because it's short in the front and long in the back.
Yeah, I think we talked about that last time, Mark.
Yeah, I think we did. You guys are full of catchy spread names. I like it. I'm going to bring you on just for my title convention. It makes my life a lot easier. Since we're talking VIX Futures, I was going to get to it later a little bit, but it seems worthwhile bringing up now. Of course, we are approaching the launch of the hotly anticipated VIX Weeklies next week. They're kicking it off with the futures on the 23rd. You guys are term structure players. I'm curious, are you excited about this? You think, that kind of product last week might have been kind of interesting.
Yeah, without a doubt, definitely interested to see, how they trade, how the term structure of those weeklies look, and most importantly for us, how liquid are they going to be? What kind of markets do we see on either side? The bid ask, how tight is it? But we're looking at it with a very keen eye.
Yeah, I think I like the idea of it seems to make more sense to stick with the VIX methodology and just change the expiration I think Mark and I were talking earlier that trying the VXST futures and options was a similar idea, but changing that to the 9-day from the 30-day outlook, I think it makes sense just to keep it at VIX and changing those expirations.
Yeah, no, VXST was kind of one of our big, head scratchers on this program for quite some time. It launched with a lot of fanfare. We kept an eye on it for quite some time and talked about the ebbs and flows, mostly ebbs of the volatility and the volume out there, I should say. And just it surprised a lot of people that it kind of just withered and died on the vine. Now, kind of being subsumed by the VIX weekly. So this is kind of SIBO's second tilt at the windmill, essentially, for short-term volatility. I'm curious, you guys are kind of the prototypical end user for a product like this. At least that's their intention. They want the institutional trading crowd to really embrace this product. You guys, not you, but collectively, you guys never really did with VXST. I'm curious if you think, was it just a methodology thing? I think people just weren't ready to embrace the methodology of VXST, and they want just a more, I guess you hate to say it, but plain vanilla type VIX, just shorter. You think that will solve the problem, or you think there's maybe a fundamental just lack of interest in near term vol products?
I think on VXST specifically, I think the periodicity of the index, lent itself to a really whippy index. So tough to trade a term structured trade around an index that can move incredibly wide in wide price swings. So I think it was tough, just a tough reference index essentially to put together kind of a trading methodology that you could use on a consistent basis. It was a great speculative tool, but the times you wanted to own it is the markets weren't there in terms of bid-ask tightness or liquidity. So I think, the periodicity, to have weekly things is correct. And now having a reference index, the VIX, that's not nearly as volatile as VXST can be, maybe that's the right combination of underlying index and, the ability to do weeklies. Kind of look at it like the success of the S&P weeklies. We think we hold out high hopes for the VIX weeklies.
Yeah, there's some interesting ideas I'm thinking about just in terms of spread trades between the two, between the weekly VIX futures and the other ones. I think that keeping the methodology the same on the underlying makes those things a lot more approachable versus, it's not quite like for like if you're trying to spread VXST and VIX. So, I have high hopes for these weeklies.
Yeah, keeping the contracts similar is certainly an important distinction when you got people trying to spread back and forth. And we're talking about popular broad volatility products. A lot of people have been writing into the show of late, asking about a broader suite of vol products, not just the VIX, even though people love the VIX still, but they're also looking a little bit farther afield overseas to things like V stocks. We've had an amazing surge in listener interest about V stocks of late. Probably no surprise given the fact that a lot of the vol was stemming from the Eurozone out there. So I'm curious, I think last time you guys were on the show, we were talking to you guys about how you were starting to look at farther afield at other volatility products. You were kind of lamenting at the time, I believe this was back in April, lamenting the kind of dearth of potential trades for you out there in the VIX futures term structure. If it wasn't lining up for you, there wasn't much for you guys to do. So you were starting to look farther afield. Since then, have you guys started looking at V stocks, and is that a potential trade you're seeing line up out there? Maybe the term structure a little bit more favorable out there from a V stocks perspective. What's your take on that product?
Yeah, we do have a few models that we've been working on for V stocks. Traditional term structure trading over there. It is this sort of it's a second, but a distant second in terms of daily liquidity. This most recent dust up, it was definitely the curve over there went backward kind of end of May, and so the volatility stayed localized to Europe for quite some time before finally spilling over to the U.S. End of June, beginning of July. So those types of extremes in the relationship between V stocks and VIX are certainly tradable, and that's something we look at. So it's definitely would be the next contract that we bring on. Unless the VIX weeklies really take off quickly. But that is something we do like to look at, and we do trade a little bit on a proprietary basis.
How would have a long fire have performed
during the crisis that took place in Europe? Did it do what it's supposed to do?
The long signal for us fired end of May. Would have had a big June, and then I haven't updated it through the most recent cool off, but it would have done well certainly beginning of July. July would have been a function of when the long signal turned off.
The long fire, is that one of your proprietary signals?
Yeah, that's what Sebastian calls our long signal, long fire. So yeah, it is one of our proprietary signals, one to get long.
The long fire is my nickname for their signals and my one really tall redheaded friend.
Yes, what a surprise! Mark has a funky nickname for something. I've been accused of doing that myself as well here, so I can't complain too much. Refresh my memory, guys. I know you guys mostly play in the futures. Do you guys sling the options at all over there as well? Particularly VIX options, maybe V stocks as well.
Yeah, V stocks options are not approved by the CFTC, so not tradable by U.S. clients. VIX index options, since we are a CTA, we do use a little bit of them for a fund that we run. But since they are SEC products, you have to stick under the de minimis rule. So we do use some options overlay over the top of our futures, essentially as a hedge for our underlying futures position. So it's a complement to our futures, not a core driver of the P&L.
You mentioned the V stocks kind of being a distant second to VIX when it comes to volume. That seems to be a common refrain out there. Everyone kind of putting a little bit of a wait and see. It's the old catch-22 with any product. I'll dive into it once it has more volume. Of course, needs to get more volume first, and you can't get that. People don't dive into it. So it's a bit of the catch-22 of any product. But you're right, it is a distant second when it comes to VIX, certainly from an options perspective. Talking about VIX options, this was the week of VIX options volume explosion out there from an overall volume perspective. VIX options still hovering fairly call heavy, but nowhere near as high. Got up to around the 4 level, which a lot of people who tend to watch that indicator viewed as a very historic level, really potentially signaling something crazy in the marketplace. Sure enough, we did see something crazy, though perhaps not as crazy as some people had been predicting. All those people who had been buying up the entire call skew in July probably went home a little bit disappointed, at least on the options side. On the other side of the fence, on whatever they were hedging or specking on, they're probably pretty happy. But on the options side, straight up, probably some sad faces out there. But this week, from a volume perspective, no sad faces. It was lighting it up. I'm trying to remember another week that compares to this one. Certainly on an individual contract day basis, Monday blew the doors off everything because our old 1x2 swap friend came back on Monday, slinging some size yet again. Remember last time we talked about this particular trader, listeners, he was rolling from July to August. He rolled out to the AUG 1723, 1x2. He had sold 117, bought 2 of the 23s. I think he did it 188,000 by 376,000 times. Came out and did it again. He bought back the AUG this time, sold SEP, adjusted down a handle, so he sold the SEP 1622 1x2 again. I think about 188,000 by 376,000 times. So net well over 1 million contracts yet again in the whole kerfuffle there. Net paid 8 cents for it too, which is kind of interesting. So that on top of the fact that it was already a robust volume day out there, already doing a million contracts or so on its own, that pushed the overall volume to 2.2 million contracts, second highest VIX options volume day ever. If you're wondering what the number one day was, I was as well. So I went and dug it up. It was February 3rd of 2014 when they put up 2.4 million contracts. So that was the number one day. But this Monday, a very, very strong number two. It continued throughout the week. No surprise with contracts going out this week. A lot of volume going up. Nearly a million contracts again on Thursday, about 500,000 on Wednesday. Just crazy volume. And also still the same refrain we've seen overall in July carrying through to August. Yet again, people loving some upside in AUG calls. The AUG 24s and 25s are lighting it up again this week. So maybe the same paper buyers who were buying upside all month long in July and showed absolutely no willingness to sell it Even when VIX Cash and VIX Futures were popping, getting up to around the 20 handle, that was your one opportunity if you wanted to get out of any of that upside everyone had been loading up on for the entire month, and pretty much no one took advantage of it. So that shows that people were hedging or specking on something far greater than just a spike up to about the 20 handle. They really were looking for something a lot bigger. Mark, this was clearly a crazy week from an overall VIX options perspective. In addition to our 1x2 friend, our 1x2 swap friend, there was just paper lighting it up all week long. Anything really catching your eye out there from an overall volume perspective out in VIX options land?
I mean, we're still seeing lots of, toward the beginning of the week, we still had people trying to execute like the 1x2 trade where they buy one and sell two. But across the week, we saw lots of people closing out relatively big July positions and rolling them back, and primarily not in August. As I look at where the VIX volume is and where all the action is, a lot, in relative terms, a lot of the interesting paper is being done in September, not in August. And I think it has to do with the Federal Reserve, which, people are forecasting is potentially the next big vol event. But we have seen, some August upside calls trade, some different ratio trades. I saw an interesting upside call stupid get sold in August. They sold the 16 and 17 calls in size. So, when you see a big, huge VIX spike and a lot of people get involved, there's some unwinding process. But I think the interesting piece is that a lot of that paper is really moving into the September timeframe, and is more interested in that than in August, which maybe speaks to why the curve has gotten so steep.
And Matt and Mike, you guys obviously say you're mostly futures. The options are a bit of an addition and overlay to your futures portfolio. But a week like this, clearly a very active week. It certainly must have caught your eye out there, particularly our friend out there who just keeps rolling so much size. Did any of this stuff really catch your eye and really maybe facilitate you guys getting off a few more options trades than you would have this week, just because there was so much paper going up in the VIX options?
Yeah, there's definitely a lot of opportunity to kind of leg into some spreads. We like the 1x2 back spreads on the call side to hedge our futures position. So given all the movement, you could have legged into that spread for a decent credit here. We do like September right now a little bit better than August. I just think seasonally, Europe kind of goes to sleep in August historically. And, some of the options in the SPX that are going to be in the VIX index come the Fed meeting, even though September VIX expires on Fed day, the options underlying the VIX index will be in there. And those could catch a bid if people are afraid that the Fed's going to tighten rates and have that mean anything to the market. So definitely a lot of opportunity just given the movement in there to leg into some of the protective positions we like.
And you are right, Mark. There is a lot of positioning out there in SEP as well. In addition to August, it's kind of hard to really make heads or tails of all the hot options these days because our 1x2 friend just obscures everything. He does so much volume. The top one, the number 2 strike overall is the SEP 22s, but that's because our friend is playing out there to the tune of 100 some odd thousand contracts. And of course the SEP 16s also hot out there. Again, the other side of his 1x2. Surprise, surprise. So he continues to light it up with the big strike still being the July 23s with about 400,000 open on that strike there. So interesting stuff here. People not taking the opportunity. We'll see if that carries out into August SEP. I think your mindset there, Matt and Mike, is not a unique one in the fact that August, you're right, tends to be a very quiet one from a European perspective, and we all know the European institutional customers, big drivers of SPX and VIX. So if they don't play, then who indeed will be coming to play in the coming months? Again, a question we'll get to in a little bit when we get to our crystal ball segment. Where will the vol come from? Since we're talking about sources of vol, we'll get to it really quick. We are, of course, in earnings season right now. We're going to talk about a lot of individual name adjustments, volatility, movement, what have you. But Google is so aggressive, so dramatic. Yet again, you kind of have to bring it up at the very least. People are already writing in with questions about Google and all that fun stuff. We saw them going out yesterday and with the at the money straddle right around $21. I think they were trading on 570 or so at the time. Those pricing at about a 3.5% move. If I remember correctly, a lot of people saying, "Oh, that was an interesting straddle." I know, Mark, you guys over there at Option Pit, cautioning your clients against selling it. That turned out to be a prescient move because Google just off to the races in the after hours. Are opening up today over 70 handles, and today and intraday trading they're up nearly 90 handles, trading 667. So just incredible, nearly over 4x what we were looking at on that straddle. So it's a lot more gamma than vol at this point, but still just it's so dramatic, so crazy that it merits mentioning out there. Mark, I know you guys cautioned against people selling that over there in the pit, which worked out pretty well. Any other interesting developments over there with you guys and your clients as a result of this just incredibly dramatic move out there in Google today?
This is back-to-back major internet firms that have basically doubled or tripled, or in this case 4x'd their straddle. I mean, straddles have been wrong so far. They've been too cheap. And it's interesting to kind of watch what's going on. This is one of those stories. Every time I talk to someone and says, what I do is I go out and, I wait for earnings and I sell some really far out of the money call and some really far out of the money put, and then I just bank a bunch of money because, it never moves that much. Well, the answer is it does move that much sometimes. And there's a reason those options still have value. And, VIX GOG is now 14.5. It was only 25 yesterday. This is an outlier 16% move. This is essentially a black swan type move in Google up.
Yes, the upside surprise. It's funny. You could see exactly what they were up to out there with that straddle. I mean, they priced it it was exactly identical. They were pricing it at exactly a 3.5% move because that's exactly what happened last earnings. And so it was almost identical price. And they said, well, it moved about 19 or so handles last time. 3.5% equates to about 21. That's where we're pricing that straddle this time. It makes intuitive sense, I suppose, but not in the crazy outlier moments like we're seeing here today, where the stock is still rallying and showing no signs of slowing down. Who knows? You mentioned your art, Mark. There were a few other names that have been lighting it up. So a lot of people were kind of dismissing the earnings season. Again, not to step on the crystal ball too much, but maybe perhaps there is a little bit of vol to be found in earnings season that could perhaps save us from otherwise the summer doldrums and otherwise, post-Greek event here. VIX Cash really starting to flirt with some single digits even, perhaps. But before we get down to that, before we get to your questions, I know people also looking out there in crude oil land for some signs of life, for some signs of volatility. And there was a brief spark, a brief flirtation with some vol creeping back in as oil sold off again last week. Now we're seeing that coming off yet again as the vol and oil, continue to erode. We got NYMEX AUG crude hovering right around $51 as we're recording this, listeners. ICE Brent hovering right around 57.5. So both still south of that ever so important 60 handle. And of course, on the vol side, where we like to watch on this show, continuing just to erode dramatically out there, OVX and OIV both tend to move in lockstep, which is interesting. We talked about that before on the show. And both of them hovering right around a 35 right now, so well on the low end of their range out there, and certainly perhaps have some potential to move south even more. Again, we did see some names like OVX get into the high 20 handles, so there is more downside, obviously, from a vol perspective. That recent spark of life gave us a little bit of vol back in. We're starting to give that back again, obviously, but still, there is potentially more downside to move. But still, both those names well off their highs recently in the 60 handle or so. And Mark, yet again, I hate to beat this yet again, but it does once again put the lie to the Goldman claim from a couple months ago that you really needed to buy all that vol out there in crude because it was so underpriced.
Yeah, even with all this crazy Iran stuff, you name it, that vol was too expensive, and as I look at it, I'd want to sell more of it.
Yeah, that certainly has been the right end of the trade to be on. Those Goldman guys and anyone who followed that client letter to buy up that downside vol there in crude are not happy from an underlying perspective. Certainly not happy from a volatility perspective. It hasn't really worked out pretty much any which way. So again, we've always cautioned against following some of those big analyst recommendations, and this time certainly not the trade you wanted to put on right now out there in oil. Before we move on, Matt and Mike, we look at a lot of different areas here. We look at international volatility. We talked with you about V stocks earlier, and I'm curious, as you're looking at the VIX term structure, getting ready for the near-term products, the VIX weekly futures to launch next week. Are there any other products, really kind of catching your eye these days, futures-wise, options-wise, anything else in the volatility realm that you're starting to look for and really starting to consider maybe incorporating into your portfolio down the road?
Yeah, I think, given the movement in China lately, we're hoping that the SIBO does something with the Chinese VIX futures that have been rumored about. So obviously not tradable product right now, but that VX FXI has been quite the mover as of late. So we would love to see something in that space, that's tradable.
And, since we're talking about other products, let me get your opinion really quickly. One of the ones, you guys are futures guys. One of the big products in the volatility space of late has been, of course, the AccuShares product, attempting to essentially replicate and create a tradable spot VIX with perhaps a lesser degree of success than some may have hoped in that structure. Also trying to create a product that was impervious to the contango we see out there in the term structure, also kind of not really delivering that as well. But I'm curious if you guys have watched that at all and seen its progress in the space, and what your take is on that product as its core function, which is trying to deliver that spot VIX product in some sort of tradable securities form.
We had a lot of questions on it, before it launched, and we had a lot of people basically forcing us to look at it, and it never made too much sense to me that it would be even possible to offer a product like this. The contango is not the contango that are in VIX futures is not some evil conspiracy. It's the natural. It's the natural order of things that if you're going to offer protection, it needs to come at a certain premium. And so I think that's basically what you're seeing in those products is, sort of the natural market forces just working their way through, and they're being essentially forced to look like VIX futures.
Yeah, again, which is why I thought it might intrigue you guys, because it is starting to encroach on your territory, whether intentionally or not. That seems to be the way that product is going.
Right. Yeah, I guess we never saw a reason why it wouldn't trade somewhat like a future, but just in a securities package with a fee on top. So the performance of it hasn't really surprised us too much. I think, trying to put together a product that trades like spot VIX is essentially next to impossible. Because if you could just own spot VIX, it's essentially free insurance, because people would load up on it down here, and it doesn't matter if it ticks down a little bit. At some point in the future, you'll be able to get out at a profit. So I guess we're not too surprised by the difficulty in issuing a product that trades like spot VIX.
Yeah, I think probably most of the people using it are doing some sort of arb between that and the futures and the IV of the product itself. So I hope there aren't too many retail folks in there still thinking that they're owning the VIX.
Yeah, it does not behave that way at all, does it? So, the closest thing I can think of that might potentially somewhat get close to a spot VIX, but it will have a cost to it, is when our friends over at the Volatility Exchange eventually launch their SPY realized volatility product at 30 days to expiration. Theoretically, it should match VIX, like spot on, correct? Because that should be the market, a 30-day contract should essentially be VIX, right? VIX is a 30-day contract on realized volatility. So as that becomes a tradable product, what I think you'll end up seeing if somebody develops an ETN is they'll develop an ETN that basically tracks spot VIX to like the front month future, and someone will have to kind of roll through those two futures as a similar to how VXX tracks the. So what you'll end up with something is that still has a contango to it, but it will have the daily volatility that tracks the VIX as opposed to, how VXX tracks a 30-day future. I mean, I think that would be the closest you come up with, but as Matt said, that will have a cost.
Yeah, that's kind of the thing that seems to have really undone just about everyone who's going into this space. Is kind of the holy grail, probably an unachievable holy grail that create that product that is quote unquote immune to that contango that retail can come in and buy and hold VIX with. That was the original reason behind launching this VIX up down product, of course, that has since changed as I think the devil met the details and they realized that was difficult if not impossible to deliver without all of these weird fees they've tacked on and things like incentives and things like that. But you're right. At the end of the day, that would be essentially giving a lot of people a free swing at the bats from a vol perspective and from a term structure perspective, and I don't think anyone could really afford to do that over the long term. Still, we maintain hope that some of these new products will resonate. Speaking of resonate, it's time for you guys to join us here on the old Volatility Views panel. Hopefully your questions will resonate as we dive right on into the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, welcome to the Volatility voicemail segment. This is the portion of the show where you guys get to join us with your questions, your comments here. A lot of you guys chiming in on a bunch of different topics. We'll kick things off. I think this will resonate with you guys here, Matt and Mike and Mark as well. Is a question here from Al P. from Oakland, California, sunny Oakland. He writes, this is kind of the type of question we get a lot around this time of year and this time of movement in the market. He writes, what is the most effective way to speculate on a true volatility explosion in the marketplace? Is it straight up VIX calls, or is there a more effective product? Matt and Mike, I imagine you guys might argue for the futures, but it is kind of hard to argue against the VIX calls. That is the one moment, the one time when they really do tend to outperform is when the market, and the VIX itself, I should say, is really exploding to the upside. That's when you really want to have those in your back pocket. The rest of the time they perform all right, but that moment is when they really tend to outperform. So it really is hard to argue against the VIX calls by itself. But that said, we can certainly do it. Maybe Matt and Mike, we'll start with you. You guys are our guests. This is kind of a derivation on another question we receive quite a bit, which is what's the best way to speculate on the market really falling out of bed using options? Here's our friend here taking the corollary to that, saying what's the best way to spec on vol just exploding? So that said, I'm sure you guys are going to argue for the future, so have at it.
Yes, VIX Futures, that's it. Yeah. I think you hit on a real important topic there, and it's to us, it's less about the product and more about the timing, and it's more about there are no great products to have consistently in your portfolio that are always long vol, where you're not going to kind of get eaten up while you're waiting. So it's to us, it's more about knowing when to put on a long vol position, whether it's in futures or options, rather than constructing the perfect constant hedge.
Yeah, I think if you time it right, and you own some VIX calls, not only will you get the price moving for you, but you get the skew to explode for you. So the first kind of move into a vol explosion, VIX calls are probably contain the most bang for your buck. If it's sustained vol event, when VIX futures go into backwardation, if you're buying, front month and second month and it's trading quite a bit below the spot index, you're going to get the wind at your back from the backwardation in the VIX futures curve. So, so that could provide, a better return than paying premium for VIX calls kind of on an echo volatility event. You can look at something like way out of the money SVIXy puts, for instance, to get to to look for any cheap gamma out there if you think a vol event is on the horizon, because something like SVIXy will, obviously take the will be hurt on the initial volatility move, and if the VIX futures curves backward, that thing will decay like VXX decays when the curves contango.
Oh, interesting. Recommending the inverse ETF. I didn't expect that coming out of you. Interesting stuff. Go for it, Mark. Where do you fall on this ever-evolving debate?
Matt and Mike are right in that you do get a really nice pop. If you can time your VIX call purchase well, you can get a really nice pop. But once the vol is spiked and the skew curve moves, that at the money and out of the money stuff can be poison, because it is based off the VIX futures. You'll get a real explosion, but then the speed with which traders take volatility premium out of VIX can be more astounding than the speed in which they'll take volatility premium out of the S&P. I mean, it is just nasty. And we get into a scenario that once the VIX gets into the 50s and 60s, the futures may keep going, but the option premium might just die. And that's something you really have to be careful and cognizant of when you're trading this stuff. So I don't have an issue owning $20 calls and even $25 calls, and on another degree, buying nickel cheap options when at the 50 strike can be an effective early form of trading. Once the VIX is kind of broken out, really made its move, the best way to get that premium is the futures, or if you actually want something that will track VIX. But the only thing that actually tracks VIX somewhat closely is UVXY, but that long UVXY is more poisonous than putting cobras in your shorts for a portfolio.
I can see your mind stretching for the metaphor there, sir. So you're saying you're not a fan of, let's say, our friend today picking up 7,000 of the AUG 47.5s out in VIX. You're not a fan of that trade?
Now that we're down here, I'm okay with it. Where I hate that trade is last week when the Greek stuff was going on.
Yeah, you wouldn't have got him for 2 cents or whatever you got him for today. That's for sure. Still a ridiculously optimistic trade, but fun nonetheless. We got time, I think, for one more here. Let's pull up a question. This comes from NV16. He or she writes, "Hey, I searched for volatility programs on a lark using PockectCast, and didn't think I would find anything. Man, was I surprised when your show came up. What a treat. 100+ episodes I've been sinking my teeth in all week. Any chance you could bring on a guest who specializes in OTC variance swaps? That's a market that's always interested in me, but it's hard to find good color on it. A good suggestion. We've been looking. We got a few on in the past. We're looking to bring on some more, because you're right, that is kind of an opaque marketplace, and it'd be good to check in on that once in a while, because all the stuff we talk about here listed, there's usually an OTC leg out there that we're not getting the color on, so it'd be great to have both sides of the trade to discuss here on the show. That's something we are working on for you, Mr. or Mrs. NV16. Really quick, he goes on to write, other than that, please keep up the good work, and thanks to Russell for bringing us this show. Well, there you go. A shout out to our friends at Russell. He goes, one more quick thing. You guys talked about how a VIX of 1 is all but impossible. What do you feel is the realistic upside limit of VIX? We saw it hit the 90s during the meltdown. Is that it? Or is a VIX of 200 a possibility one day? Wow, that would be something. A VIX of 200, I have to imagine what would be going on in the political, macroeconomic climate to derive something like that. That might be the scenario similar to like selling, the S&P 300 put, where if we get down to that level, you got other things to worry about aside from that put coming against you. Maybe the same thing with the VIX of 200 strike. Maybe if we hit that level, there's so many other horrible things happening that the VIX of 200 is the least of your concerns. That said, Matt and Mike, this is probably an interesting thought question for you guys. What do you perceive being the theoretical upside limit of the VIX?
Yeah, good question. Some of the numbers we think about are probably mean terrifying things for the market, so no one will probably care if it ever happens, but frame of reference, I think VXO traded maybe 150 in the 87 crash. So approaching that 200 number. I think if you look at something simple like, take your at-home option pricing calculator and start plugging in high numbers of VIX for kind of the at-the-money S&P put, let's say, if you start getting in numbers in the 400-500 range, it starts making the cost of protection quite a bit less than the strike price to S&P 0. So a theoretical VIX of 1600 would mean your put costs as much, if not more, than your strike price. So making it obviously uneconomic for a buyer. But so to me that means like practical upper limits where people just wouldn't play would be in probably the 250 to 300 range.
Yeah, you can. There's a handy tool to use to understand what any given VIX level means in real terms is the rule of 16. So take any VIX and divide it by 16. The number that you end up with there is the market's expectation for one standard deviation of the daily moves for the next 30 days. And so a 200 VIX divided that by 16, that's 12.5. So that a 200 VIX is people transacting options with the expectation that the S&P is going to be up or down 12.5%, 20 of the next 30 days. So you're talking a really extreme view there. And the option obviously is going to be extraordinarily expensive, and that's a huge bet to be taking. So it's more of a natural market force that's going to keep it below numbers like that.
I like your other explanation too, that it actually breaks down around 1600, which is in and of itself a terrifying level. I can't imagine what a 1600 VIX what that would
1600 implies the S&P will be up or down 100% at some point in the next 20. So that's the end of the world scenario.
That is pretty much global meltdown.
What was market realized volatility during like the stock crash of 1929? Was it worse in 87 or worse in 29? And what where would, if we think about that as maybe the absolute worst case scenario, where would that, or like look at China, it just dropped 30% in a couple of days. Where did the vol get there? Those are things to look at, and I think. I want to say 29. The VIX doesn't even get to 250 on that scenario, correct?
Yeah, I don't think so.
Yeah, so 200 is going to be about your upper bound. But by the way, our friend that brought up our low bound of 1, I think that's probably incorrect. I don't think you could actually have a VIX below 8. We've never actually seen one below 9 or settle below 9. So, at a certain point, there's got to be some insurance premium. So even if market volatility went to, let's say, 1%, the VIX would still have a value of 5, maybe 6 at that point.
I think that was an episode Andrew and I were on. I think we were debating. I think we came up with around a 5. Yeah, we all said 1 was a no go, but 5 seemed like an aggressive downside limit. Yeah, you're right. Practically speaking, probably an 8 or so in that range. But yeah, that's an interesting question. I like these kind of bizarre thought pieces to call them something fun. But yeah, it's interesting questions. Keep these coming. We love to hear from you. Unfortunately, that's all the time we have for the volatility voicemail this week. Keep them coming. Even if you don't read them on the show, we read them all, and we love your questions. So let's go into really quick, we're running out of time, a really quick crystal ball segment.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, welcome to the crystal ball. Like the man said, this is the portion of the show where we prognosticate wildly and recklessly on the future that is in store for us from a vol perspective. Last week we were talking about what would happen post-Greece, and turned out to be one of the worst VIX apocalypses in recent memory. We're south of the 12 handle now out there in VIX Cash land as the show continues, so the volatility continues to erode as we record the program. Matt and Mike, we'll start with you. The kind of an interesting scenario we're in now. We're heading into the summer doldrums, so you'd think lower. The Greek thing is behind us, so you'd think lower in the near-term future. But of course, we just talked about Google and a few other things. Perhaps maybe they have the potential to spark some life into the market from an earnings perspective. So where do you fall on the week ahead from a volatility perspective?
Yeah, I think week ahead, we do have a VIX expiration on Wednesday, so I would expect a pretty soft settle for the July contract. I wouldn't be terribly surprised if it settled below 13, 12.5, 13. And then the back half of the week, if participants start rolling some of their protection into August, you could easily see, a couple point vol tick up on just people re-racking their protection in August and September. generally speaking, earnings season is kind of a vol negative event overall, as volatility, like you've seen in Google, for instance, kind of comes out of the market after the event or the announcements are released. So I think kind of a slow deflation through Wednesday, and then probably a couple point rotation higher in the back half of the week. See, August is trading 20% over spot right now, so that's partially reflecting that expectation of vol bouncing from an 11 handle to something a little bit more reasonably higher.
Mark, same question for you, sir.
Yeah, I mean, as I look, I don't disagree with the soft settle. We do have earnings that could push things around a little bit, but the NDX is just off to the races. I would be now that we've crossed the 13 threshold and held it there for a few days, we may be below 13 for through the end of the month, and so it could be a very slow, non-volatile premium sellers market for the next few weeks. That being said, I look at August with a month to go, and I can buy a 14. If I'm looking for insurance, I can hedge at the 14.5 strike. That doesn't seem like a terrible hedge against a basket of long stocks. The cost associated with something like that seems relatively inexpensive. So at these insurance levels, I would be an interested buyer.
And while you were talking, I was just looking. It was an interesting thought question. What was the actual vol out there in 1929? According to our friend Bill Luby over there at VIX and More, and I think he actually pulled it from Yahoo, but I tend to trust Bill's numbers. It hit a 20-day peak for historical vol of 111 out there in 1929. So put that in your pipe and smoke it there, listeners. Talking about our VIX and 200, 111 there in 1929 for some at least historical S&P vol, or what the index market was at the time perspective. Still interesting stuff. VIX at 200 would indeed be a meltdown of epic proportions. Well, unfortunately, that's all the time we have for the Volatility Views program this week. But before we go, as always, let me check back in with my cohorts here to see what they have cooking. And Matt and Mike, since you guys are our guests, I'll give you pride of place. If our listeners like what they're hearing, they want to check out more about what you guys are working on over there at Typhon, where should they go?
Our website's typhoncapital.com. Typhoncap.com.
Well, there you go, listeners. If you want to learn more about the mullets and the kick in the can trade and all the other fun stuff they talked about here on the show, surf on over to typhoncap.com, and you could learn more for yourself and kick the tires over there. And Mr. Sebastian, I know you have a lot of stuff cooking over there. What's cooking in the land of the pit?
Follow me on Twitter at OptionPit. That would be what I would do.
There you go, listeners. You can get all of his goodness throughout the day. If this is not enough for you once a week, you can get it minute by minute throughout the day over there at OptionPit on Twitter. And on behalf of Matt and Mike and Mark, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And, of course, for sending in such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. Or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.